Basel Accord. Basel Committee on Banking Supervision, commonly known as Basel Committee, is a committee of banking supervisory authorities that was established by the central bank governors of the Group of 10 countries in 1975. Now it consists of 13 senior representatives of bank supervisory authorities and central banks from Belgium, Canada, France, Germany, Italy, Japan, Luxembourg, Netherlands, Spain, Sweden, Switzerland, United Kingdom, and the United States. It usually meets at the Bank for International Settlements in Basel, where its permanent secretariat is located. The committee does not possess any formal supranational supervisory authority, and its conclusions do not and were never intended to have legal force. Rather, it formulates broad supervisor standards and guidelines and recommends statements of best practices, detailed arrangements, statutory or otherwise, which are best suited to their own national systems. This lesson discusses various aspects of Basel Accord 1 and 2 and their implementation. It follows from the previous slide that after studying this lesson, you should be able to understand the feature of Basel 1 and Basel 2, know the norms regarding Basel 1, understand the capital adequacy under Basel 2, describe the implications of Basel Accord 2. Basel 1, that is, the 1988 Basel Accord, primarily focused on credit risk. Assets of banks were classified and grouped in 5 categories according to credit risk, carrying risk weights of 0, 10, 20, 50, and up to 100%. Basel II is the second of the Basel Accords, which are recommendations on banking laws and regulations issued by the Basel Committee on Banking Supervision. The purpose of Basel II, which was initially published in June 2004, is to create an international standard that banking regulators can use when creating regulations about how much capital banks need to put aside to guard against the types of financial and operational risks banks face. Banks with international presence are required to hold capital equal to 8% of the risk-weighted assets. The Basel Accord 2 has 3 pillars, namely minimum capital requirement, supervisory review process, and market disciplines. Pillar 1 sets out the minimum capital requirements firms will be required to meet to cover credit, market, and operational risk. Pillar 2 sets out a new supervisory review process. This requires financial institutions to have their own internal processes to assess their overall capital adequacy in relation to their risk profile. These are subject to review and evaluation by their supervisors. Pillar 3 cements Pillar 1 and 2 and is designed to improve market discipline by requiring firms to publish certain details of their risks, capital, and risk management. The intention is that disclosures should be in line and how senior management and board assess and manage the institution risks. The Basel Capital Adequacy Accord marks a major milestone of banking regulation. Companies are required to cushion the risks of their business activities with appropriate allocations of risk capital while having great methodological freedoms to determine the amount of economic risk capital. Increased sophistication of markets and products, competitive forces, globalization, and colliding interests of various stakeholders such as board members, customers, employees, investors, supervisory agencies, and creditors necessitate a balancing act between efficient use of capital and prudent capital allocation to cover these business risks. This requires first and foremost the development of appropriate risk models to identify and quantify all significant risks accurately. To meet the requirements of the Capital Accord, companies need to perform a detailed evaluation of their existing risk management principles, regulatory systems, and processes. They have to recognize and implement the changes necessary to fulfill the risk management and reporting obligations in a timely and accurate way. They also have to provide capital to support the regulatory framework. Capital funds are broadly classified as Tier 1 and Tier 2 capital. Two types of capital are measured: Tier 1 capital, which absorbs losses without a bank being required to cease trading, and Tier 2 capital, which absorbs losses in the event of winding up and so provides a lesser degree of protection to depositors. The RBI has stated that at minimum all banks in India to begin with will adopt standardized approach for credit risk and basic indicator approach for operational risk. After development of skills both at bank and supervisory levels, some banks may be allowed to migrate to IRB approach. Parallel running can be defined as the simultaneous operation by a firm of its existing systems to measure capital adequacy and a new systems to generate figures for both credit and operational risk under Basel II. It seeks to ensure that firms have developed and tested the risk measurement system and capital calculation engine and have embedded the necessary supporting systems and controls into their business operating environment. The parallel run consists of several steps. Banks are required to apply the prudential guidelines on capital adequacy, both current guidelines and the guidelines on the revised framework. These 7 steps are enlisted on the screen. These include board-approved policy on utilization of credit risk mitigation techniques and collateral management, board-approved policy on disclosures, board-approved policy on internal capital adequacy assessment process (ICAP) along with the capital requirement as per ICAP, adequacy of bank's management information system (MIS) to meet the requirements under the new capital adequacy framework, the initiatives taken for bridging gaps, if any, and the progress made in this regard. Impact of the various elements or portfolios on the bank's CRAR under the revised framework. Mechanism in place for validating the CRAR position computed as per the new capital adequacy framework and the assessments, findings, recommendations of these validation exercises. Action taken with respect to any advice, guidance or direction given by the board in the past on the above aspects. Basel II represents a significant opportunity for banks to enhance their risk management processes, models, abilities and linkages with the rest of the organization. Basel II is more risk sensitive, recognizes developments in risk measurement and risk management techniques employed in banking sector and accommodates them within the framework and aligns regulatory capital closer to economic capital. Basel II brings improvement in the risk management and risk measurement systems. Pillar 2 of the framework provides greater scope for bankers and supervisors to engage in a dialogue. The added transparency in Pillar 3 should also generate improved market discipline for banks, in some cases forcing them to run a better business. The improvements do not come without their cost in terms of time, resources, budget and organizational fatigue. It is incumbent upon bank managers to make a well-informed decision regarding Basel II compliance in light of its potential benefits and potential costs. Compared to Basel I, Basel II is considered to be highly complex, making its understanding and implementation a challenge to both the regulators and the regulated entities, particularly in the emerging market economies. The complexity of Basel II arises from several options available. Consequently, many of the countries that have voluntarily adopted Basel I also view these issues with considerable caution. Since the revised framework has been designed to provide options for banks and the banking systems worldwide, the Basel Committee on Banking Supervision acknowledged that moving towards its adoption in the near future may not be the first priority for all non-G10 supervisory authorities in terms of what was needed to strengthen their supervision. It observed that each national supervisor was expected to consider carefully the benefits of Basel II framework in the context of a domestic banking system when developing a timetable and approach for implementation. While it is true that Basel II framework is more complex, at the same time it has also been argued that this complexity is largely unavoidable, mainly because the banking system and related instruments that have evolved in recent times are inherently complex in nature. The risk management system itself has become more sophisticated over the time, and applying equal risk weights may not be realistic anymore. Moreover, for banks with straightforward business models and non-complex loan portfolios, the option to use the standardized approach in the Basel II framework is open, which adds very little in the way of complexity to their already existing models. Now let us check if we have understood the various concepts discussed in this lesson clearly. Basel I framework has provision for better risk management practices. Right or wrong? Wrong. Basel II represents a significant opportunity for banks to enhance their risk management processes, models, abilities, and linkages with the rest of the organization. Right or wrong? Right. Simultaneous running can be defined as the simultaneous operation by a firm of its existing systems to measure capital adequacy and new systems. Right or wrong? Wrong. Before we end, let us briefly revise what we have studied till so far. The Basel Committee published its first set of minimal capital requirements for banks in 1998 and the detailed document on capital measurement and capital standards on 26 June 2004. The Basel Accord II has been structured with three pillars. These are Pillar 1, Minimum Capital Requirement, Pillar 2, Supervisory Review Process, and Pillar 3, Market Disciplines. The new accord retains the key elements of Accord 1 on capital adequacy. All private sector banks are already in compliance with the Basel II guidelines as regards their CRAR as well as Tier 1 capital. Further, the Government of India has stated that public sector banks must have a capital cushion with a CRAR of at least 12% higher than the threshold of 9% prescribed by the RBI.